understanding that the dogs are going to go nuts at certain points. So, hey everybody, we're here with George Coyle. We're talking about my dogs. So basically, my dogs are just kind of part of the brand now. You just have to understand that they're just here, going to be in the background from time to time. I've turned off the background noise as much as I can over the years. I don't know if I could do it any more than this, but a bunch of ideas we were talking about today, and one of them that kind of stuck out to me was the idea of discretionary trading and a couple of the things George was talking about, because I find it interesting to think about discretionary trading compared to systematic trading. And even the good discretionary traders, I see most of them kind of have like what I would consider like bumper bowling. Where it's kind of like, at the very least, if you are a discretionary trader, you still have some way of like having some way or some system that kind of keeps you in line. At the very least, it just doesn't end you up in the gutter. So George, what did you mean by that with discretionary trading?
Well, I think that the good discretionary traders are rules-based and they're not systematic, but they're close. So a good example would be, let's say you use like a realized volatility filter to take a signal, and you say in a system, if the realized volatility over some time frame is more than 5%, I am not going to take this trade. Now, a discretionary trader might use the same thing, but he might or she might look at it and say, okay, it's 5.001. I'll take that trade, right? Whereas the system, as you know, if you code it up, you can't do that. So the distinctions between discretionary and systematic can be very subtle because, as you know, all the systems are ultimately designed using discretionary logic. But all that said, this guy, Pradeep Bond, who's Stockbee on Twitter, he's kind of a trader, X. He's a trader and trader coach. He wrote down this thing about active traders and their methods to trade. And he talked about, you want to determine what your universe should be, stocks or futures or what have you, the method to enter, where you're going to get out if you're wrong, the technique to exit outside of the stop, how much to risk. And I think that's very true about trading, whatever the style. And what I've found is like Bill O'Neill, I think, had a very good philosophy, probably one of the best, at least in terms of articulating it on paper. And he talked about specific setups that he would look for. So the setups would be, he had his like cup with a broken handle, and it doesn't really matter is what I've found. Like Livermore had his pivot point, and Peter Brandt writes a lot about his technical setups. But I think the larger point is you determine what setup you use to put on a trade, right? And then you define everything else, with a little bit of subjectivity, that 5% thing, and then you put on the trade. And that's really the best that I've ever seen in terms of how somebody could learn to trade discretionarily. But it really got me thinking. And so I wrote a response, and I'll read it here. And it's like, here are the other important things to consider. The ability to spend long periods of time doing nothing, waiting for setups. So with those guys, if you don't get a setup, you don't do anything. You just sit there and wait. And that could be 6 months, could be a year, could be 2 years, right? 2 is the confidence to keep going despite drawdowns and repeated losses. 3 is the ability to forget about the losing periods and to get aggressive when the good times return. So a lot of times, if you're trading this discretionary approach, you get emotional because you're taking losses, you're losing, you're in a big drawdown, and then the good times return. And it's just like, oh, this is going to be the 15th, shitty trade. I'm not going to, pardon me, bad trade. I'm not going to take it. And then that's the one that winds up paying for all of them, right? And then I guess the final point on this discretionary approach is you need to have the stamina to deal with all of this, because it gets very frustrating and very exhausting. And as I was thinking about all this, and again, this amalgam of rules, and here I'll share this if you can put it in the chat so people can read, since I went through that quick. But that's really what it takes, I think, to be a good discretionary trader. The closest thing I've ever found to how to define it or explain it to someone, to teach someone. But I started to wonder, how does this compare to a system, right? And all these human frailties, in theory, go away if you just trade a system. Now, people have to be able to actually implement their system, and that can be tough, right? It's easy to look at it and get freaked out. It's not like your emotions go away just because you're systematic. But I realized that also, and I'm kind of running around here in my head, but it's like, the discretionary guys have the best results. They have the best compound annual growth rates. They have the best drawdowns, but usually this reflects specific periods of their careers and maybe not their entire career. And so I started to wonder, okay, well, what if you looked at their whole career, which we can't really do because there's not one central database of the entire lifespan of somebody's returns from hedge fund status to family office or whatever. But it really just got me thinking and got me to start saying, how does this approach work? Like, the discretionary approach is very good at taking time and sitting on the sidelines and doing nothing. But when you do nothing, you don't experience a drawdown, but your average returns are going to come down. And what I found in my own personal trading for the most part was those periods of doing nothing reduced my my compound annual growth rates to a level where it was like, I should just be running a system. I'd have a greater drawdown for my CAGR, a lower MAR ratio, but I wouldn't have all this, like all the headaches, the confidence, the exhaustion, the frustration. And anyway, it's very, very long lead into, I started to think about like, okay, so if you're trying to make big money, sort of online with how Bill O'Neill said you should, and some of his guys do, there's really two ways to go about it. One is to use a lot of leverage, capture a bunch of short moves, right? And then two is to capture big moves and essentially get the entry perfect and then just sit on that thing for a while. So I started looking at charts and I said, yeah, it's interesting if you use different high-low breakouts, which is what most of the main trend followers do for their style. They don't use moving averages predominantly. They use highs and lows for whatever reason. And it was an interesting exercise in sort of exploring like, well, what does it take to make money? And I think you may have a chart that you can bring up, Jason, but it's like, if you look at a 5-day high low versus a 50 versus 100, it sort of tells you a lot about this is what it takes to make these big returns. And the difficulty of trading really fast is, it's high. It's the emotional consequence. It's selecting from these moves, which breakouts should I take? And, that's subject to your setup. But as you step back and look at all of it, I just started to think maybe the best approach, at least for me, is to run a system. Because if you consider the entire lifespan as opposed to this great window where people made money and the effort and the emotional consequences, maybe a system's just a better way to go. So anyway, I guess, what is this? I think you're muted.
This is NVIDIA.
Okay. So I looked at this.
Blue line's the 5-day.
Okay.
And then the gray outline is the 50.
Can you make the chart dark as opposed to white?
If it's dark, it's gonna black out the lines and other things. So I could make the maybe candles better. It's hard to see just because the 5-day is so volatile that it's like it's kind of rough.
Yeah, I guess that's sort of the point, though. Anybody can get a chart service and, in theory, put on highs and lows and look at it. And if you put on like a 5-day, and I see a lot of these gurus on X, they say, the 5-day or the 6-day or whatever. And you just look at that chart and systematically, you are in and out so often that you can't really capture a big move. So either you're using your setup approach to try to get the perfect one of those trades that moves for a month with leverage or whatever it may be, or you elongate and you essentially use longer dated breakouts, which is pretty much what all the people that do this professionally over a long time period recommend. You don't read the books, and the traders like the Livermores and the Baruchs and Sakota, they don't say like, you should be playing for the 1 hour trend. They're talking about like months and years, right? And when you look at these high-low breakouts, I think it's interesting because you see, okay, to capture the move in NVIDIA, just as an example, from let's say early 2023 when it was $20 a share to now, if you had used a 50-day high low you'd have been stopped out in November of 23. And you'd have got back in, but you'd have also been stopped out in August. And if you use a 100-day high-low, you'd have actually, I believe you would have just narrowly avoided being stopped out in November of 23, and you'd have sat on the whole move.
Yep,
So-
right there. So right where the cursor is. So the blue line's 100 now. I changed that from 5 to 100. And so if you look at the blue line, you can see that basically you're absolutely right. Like 100 caught the whole move. And honestly, the 50 only got stopped out, like you said, in the end of 23. And then the 50 got stopped out in August 24. So it's, even though, like, you know, it's not a perfect trend, it's still pretty good.
If you compare that to the 5, oh, sorry, go ahead.
At least much better than a 5-day.
Right. And I guess that's sort of just what I've been processing or thinking about. It's like, okay, if you use that discretionary approach, you're trying to use a setup to get effectively a perfect entry. But then you have to use either you're in and out all the time trying to capture these short-term moves, which, as we see systematically, winds up in not great results because you get chopped up. So in theory, your discretion enables you to avoid the bad ones and capture the good ones, in theory. Or you elongate the approach and you just say, hey, I'm going to run some kind of system on a few stocks that I think have the potential to go up a lot. And I've got that consistency and you know, I'm going to be with it. So to me, be with the trend, the larger trend, and make the money if it goes. This is just something I've been wrestling with lately. And I don't claim to have the right answer. I'm kind of thinking out loud here. But I guess where my head has started to be is, you know, the benefit again of the O'Neill style approach, or at least my interpretation of it, is you can sit out and spend long periods of time doing nothing, so you can really manage your drawdowns well. But I think those periods of zero return for months or potentially years drag your compound annual growth rate down to a level where it's like, geez, I probably should have just used a basic system on NVIDIA or whatever my stock selection set is. And I'd have made about the same CAGR, and I'd have had a bigger drawdown for sure. My MAR ratio might have been 0.3 as opposed to 1.0. But the cost of that higher MAR ratio in discretionary trading is just a lot of the stuff that I mentioned before and that I think you posted. It's, you know, it's the emotional side. It's being like, okay, I've gotten chopped up 10 times in a row, but this is the one, and I'm not going to allow sort of my memory of the recent losses and the fact that I'm down 25% impact me. I'm going to go all in on this trade. And anyway, I don't claim to have a right answer, but I guess in my own head, and I have over the years kind of danced back and forth between these things. But the more I think about it, the more I feel like if you're really thinking about the long haul, I kind of feel like a system or a process that's systematic that can adjust is probably going to win out over you know, just a flat out discretionary approach. And obviously, historically, the discretionary guys have the best returns. In the future, they probably will too. But again, that's on a subset of their actual career or trading as opposed to the whole thing. So that long, messy situation is what's been on my mind lately. So I figured I'd share it with the viewers and you. And yeah, I welcome, you know, anybody's thoughts or input. I'm going to write a post on this soon on my Substack so people could comment or read it more concisely than I've conveyed it here. But yeah, what do you think, Jason? I mean, do you have a strong feeling or opinion on any of this?
Oh yeah, I like that you brought this up because it's something that I think it's on a lot of people's minds, and it's something that actually the conference I was just at that we were talking about earlier, like this came up too. There was a speaker who talked about systematic trading, and they talked about position sizing and then entries, exits being systematic. And somebody asked the question, well, you know, how do you remove cognitive biases? How do you remove this? And he said, well, you're systematic so that they don't exist. And I thought that was a ridiculous thing to say because it's not, it is true and it isn't true, right? So if I'm in a conversation, and this is like inside baseball for traders, and George, you already know this, but if I'm sitting in a conversation with 20 other traders and we're all talking about being systematic, there's going to be 10 of them that are going to say, in the last year, I went off of my system a little bit. I did some trade. I front run my system. I did this, like they're, because basically at the end of the day, and it's the reason, Tom Basso is probably the only person I've ever met that's like me as a systematic guy. And I'm a little differently systematic than most of these people, but as a systematic guy, Tom will say, well, sometimes you need a break from the market. That's an insane thing to say to most systematic traders. They say you're going to miss this, you're going to miss that. And I'm not saying like, hey, like, wait for your, there's going to always be signals if you're trading macro markets and futures. You're always going to have signals. There's not going to be a day where I'm going to have zero trades on. There's always going to be something moving like gold. It's going to be an uptrend or a downtrend, or something like bonds or currencies, whatever. Something will always be moving, even if equities aren't. So I will always have signals, but there will be times where the amount of stress and pain that you're dealing with, that you might need a break. And I think that's okay to take that break at times, but most systematic traders would say, hey, don't do that. And I think generally, being a discretionary trader, the good ones have some form of methodology, just like you mentioned. You have people who look for specific setups. And then there's always the systematic side to everybody who's a good trader that we've ever known, which is the position sizing. The position sizing is, I think there's really two things to be successful across all markets, all time frames, which is having systematized position sizing and systematized distance to stops, or however your risk management is. And those things, I haven't met somebody who said I don't do. There's that guy in the book for Unknown Market Wizards, because somebody's probably going to be like, well, there was this one guy. Yes, there's a guy in Unknown Market Wizards who talks about how he doesn't use position sizing or anything. And I don't think it'll exist in a few years. Like, I'm not saying like it's a perfect science and you will be the best trader in the world the second you figure this out. I am saying that the math works. If you're having small winners, big losers, like, you're going to make money over time. If you continue to trade your account huge, and let's say you trade your account full size every single trade. Let's go even a step further. Leverage, 5-to-1 leverage each trade. You have 100K, you're betting 500K in each trade. That means a 20% move can wipe you out. Do you think in all of these trades you will never have one loser? Of course you'll have a loser, and that will wipe you out completely. So it's just understanding that position size is incredibly important. Understanding how to size to a stop, and understand the volatility of each product. Once you understand those things, trading is a lot easier. But I think it's hard because no matter what, like, there is that discretionary aspect of everybody. Even though I don't have any, as I've beaten this part out of me over the years, which is I have full conviction in this trade. Now I say, and I have this like always sitting next to me on my wall, which is I don't know where my biggest winners will come from. And that's the truth. Like, you couldn't have told me a couple years ago that cocoa was going to make the run it did. Sure, in hindsight, people could say, well, and every time I say that, somebody would be like, well, the supply and the demand and this thing and that thing. And like, sure, you can say that in hindsight, but before the fact, like, you wouldn't have, nobody in the world would have said cocoa's going to jump 300% in a year and a half. Nobody would have ever said that. That would have been insane. So once again, it's you have to have the same conviction at every trade. There's no way to really predict the market. So because of that, you need to be same risk size to your account, same trade every single time, same position size, same stop loss. And that's the key to making money, whether you're systematized or you're discretionary.
Yeah, I mean, I guess the breaks with systems, taking a break, you can design your systems, and a lot of people have, so that they look at it once a day. I mean, it's Coda talked about that, and Tom Basso did as well. So in a way, if you design, there was another guy, Bill Dreis, maybe, I think it was him, but he had like weekly signals essentially. And so you could design your systems to enable you to take breaks effectively, right? You don't have to pay attention. You just show up.
Well,
process.
more saying you're right. And for me, I don't look at my systems but once a day or my account once a week. So you're right, but what I'm more saying is there's going to be those bad periods where you are making mistakes, even if you're systematized or not, where you might need to take a break. Basso and I, when we talked, he was explaining, like, he's still got to hit the buttons at the end of the day. And if he's not feeling like hitting the buttons, and like he's feeling like he doesn't really want to take trades that he's taking and so on, like he feels like he's not in tune with his strategy, and then he might take a break for a little while. So that's kind of more what I'm saying, because he's also like me, where he doesn't have he's not sitting there looking at his screens all day long. It's just the idea of taking breaks when it's either you're out of tune with your own systems and strategies, or you're taking breaks when you're just when you just need one, like you've been getting your ass kicked and you just need to take a break for a little while, kind of is what I'm talking about.
So wait, you would shut off your system in those circumstances, or no?
It happens once every 3 years. Once every 3 years is about the average for me, so it doesn't happen much. It's like once every 3 years, I'm like, hey, I'm gonna close all my positions. I'm gonna take a week off. I'm going to reassess what the hell's going on here and then come back to it. And it's mainly just like something going on with your personal life. It's never something, I've never found a time where I've looked at it and gone, my systems are shit, and I've gone to shit and I need to change everything. It's usually like my head is not in the right place. Therefore, I'm doing something weird. Therefore, I need to reset myself and I'll come back better.
That's interesting, because when I was thinking about the system versus discretionary dichotomy, I mean, that was one of the things that I said was in the pro column of the system.
Mm-hmm.
Your emotional state didn't matter because you've already programmed the rules and you just have to execute, right? You're literally just, okay, the system says do this and do it.
Mm-hmm.
But, I guess the reality of it is you still have to take breaks, or people do, because it just gets to be a lot. Richard Dennis talked about that. The system was a nice thing to guide you, but use discretion. And he would say a lot of things that effectively went against at least the turtle rules. He'd say, like, if you're not making money in 2 weeks, get out. There was no such rule in the turtle system. And the system did, to a degree, act that way. I mean, it was fast enough that it was rare for them, I think, to hold something for multiple weeks if it wasn't working. But it wasn't explicit, but he said he did that. So he was sort of a system trader. But yeah, I guess, and this is where it gets really blurry, and it's like, well, what is discretionary and what is systematic? But sort of back to what I was thinking about is just, all these emotional factors, and maybe they do roll up to the system level, but I think they're easier to contend with to a degree with a system, if you can follow it.
Mm-hmm.
That's a big if, right? But yeah, I think it's just the thing that I found with discretionary trading after reading Stockby's comment was essentially that you've got to be able to like shake off just a disaster period and make that next trade the same way that you would have made the other trades. And that's really hard to do. And with the system, it isn't. I mean, as long as you're willing to follow your system, it already solves for all of that. So yeah, I guess the other thing, not to be repetitive, but it's like, if you look at NVIDIA, do you think you would have caught every wiggle and waggle along the way and got out and made as much money? I mean, no way, right? So if you want to capture that big move and you're trying to make a lot of money, you would effectively need to sit with that big move, including the drawdowns. Now, and then it's like, do you try to perfect the entry using your setup and just wait till you get it perfect, and then you can sit on it because in your head it's the market's money? So if you're up 500% and you take a 30% drawdown, who cares? It's still the market's money. Or do you just say, hey, this is a ton of work and a ton of agony, and if I had just designed a relatively simple system, again, my MAR ratios are probably going to be lower, but I'll probably get about the same return for a lot less agony in my day-to-day. And as long as I can follow my system, I won't have to deal with, geez, I don't have the guts today to make that trade in the same size because 10 have been losing. Again, I guess with all this stuff, there's no right answer. It's goals. It's, what are you trying to accomplish? What can you tolerate? But I've just been in thinking about his post. I just really thought about it. And it was like, there's a lot of emotional sides of discretionary trading that are, I think, harder. And I think those periods of sitting out and doing nothing, that's great because you're not losing money. It's great for you personally. It's not so great if you have clients because they'll say, what am I paying you for? But, your compound annual growth rates maybe end up being about the same over time as a potential system. And the system, you're not going to get systems like music, right? It doesn't get older. It keeps the same pace as long as you can follow it. You're not like, oh, geez, I'm 60 now and I'm tired and I don't want to have to get up and do this. You just program the system and do it. So, yeah, and probably in 3 weeks, I'll have changed my point of view on it again. And I do a little bit of both. But I just, in thinking about it, my personal, as I mentioned last week or the week before, my discretionary stock trading is not going really well, especially compared to the index. It's not going terribly, but because of all the rotations happening, it's like you get in, you get stopped out, you get in, you get stopped out. And meanwhile, the stock market just keeps going up, and it's hard not to get frustrated and be like, oh man. And I'm sure there'll be a period in the future where that'll reverse, right? And the market will either keep going down and I'll be sidelined, or like the get in and go will outpace the lack of rotations. But yeah, just kind of what's on my mind this week, I guess, thinking about what I've been experiencing and philosophizing, to use your word for this this video. So,
but I do like the idea of, I think you're absolutely right on the idea of, if you are a systematic trader, it is a little bit easier for you to hang in there, like during those rough times. Like you basically get to go, okay, well, Nvidia is sideways for a year. Like you get to go, well, the system's still long, and you kind of get to take your brain out of it a little bit. And then when it explodes higher, you're like, see how right the system is. Because really, like that's it's a powerful thing to be able to kind of sit on your hands during those periods. And I think that's why systematic trading works so well, is because people have trouble really. Like if you think of a great way to lose money is to have profit targets. If you back test profit targets, you use fibs to back test it, or some resistance zones and so on, you'll see that the trades have these like they don't have any symmetry. Basically, they don't have any symmetry. It's not it's not well, I guess I can't say that word well. But basically, when you have a type of trade where you don't have unlimited upside, and you're just capping your downside like we do as systematic trend traders, you get into this scenario where like your winners are so small that one loser will start to wipe you out. And really the key to making money, especially as a trader, is to hang on to those big trends. And so the only way I have found to hang on to those big trends is running systems. I couldn't, like Coco, I couldn't have. That's not me, because people will be like, oh, that's such a cool trade. It's like, it's not me. It's not, I didn't think it was going to be here. I didn't have a system that, or a strategy that I run in my own brain that tells me when to get in and out of things. It's, hey, there's a 50-day low here. It never hit a 50-day low for a year and a half. So therefore I was long it. That's all it is. And that makes it easy. It's the same as when you see huge trends in the stock market. If you want to catch on to major moves, like George was saying, even the 50-day low, even a 50-day low and 50-day high system on NVIDIA, you got stopped out at one point and then you got back in. Did you catch the entire trade like somebody who was, just buying and holding NVIDIA? Maybe not. But you didn't catch that entire drawdown in 2022 either. So because of all those things, you're basically making more money over time. And not to mention, the way we work as systematic traders is we're looking at, instead of just NVIDIA, we're looking at 20 different stocks. So you could have had a bunch of different winners. But the only way I really think you can hang on to all of those with conviction is to have a system or a strategy.
Yeah, I mean, I said this before, but most of the legendary money managers eventually say it's the big trends that make the big money. And I think that if you try to go 10-1 leveraged and you try to capture small moves within that, you're going to incur some really nasty drawdowns because there's no way you're going to get them all right. I mean, if you have a 1% move against you, you're down 10% at 10-1, right? And if you kind of trace the history of people that do that, I think at least the ones that come to mind, I mean, Livermore killed himself eventually. He was 30-1, right? I think he had some stuff going on upstairs. So I guess to me, it would probably be easier for the masses to capture a big move without leverage as a way to make money, as opposed to trying to, go 10-1 and capture a couple ticks, because it's just, for the majority of people, it results in a lot of agony. And I guess the other thing I'm thinking about is just, if you adopt that philosophy of, hey, I'm going to wait for the perfect entry as a discretionary guy. And if it doesn't go, I'm going to get out right away, which is what most of them do, and it works for them. But it's difficult to maintain that philosophy and sit on a multi-year move. To your point a minute ago, like, if you're sort of keyed in to say, hey, I'm going to get in, and if this doesn't go, or it doesn't go in a certain amount of time, or it goes down a few percent, I'm out. But then once it's in the money, I'm going to sit on it and endure 30, 40, 50% drawdowns. I think there's a conflict there for the majority. And just to be clear, like a trend system would say, I'm going to buy this breakout, whether it's volatile or it's not. It doesn't have to be my perfect setup. And then when it comes, I'm going to sit with it as long as it goes or not. There's obviously very dichotomous opinions on vol targeting and position sizing. But anyway, I guess as I've just been thinking more and more about the realities of discretionary trading, there's a lot of emotional difficulties to it that in theory go away with systems. And maybe it is just a theory, because systems make it easier to follow the signals as long as you can follow them, but it does roll your emotions up a level. Mm-hmm. But I do think, like the periods like you talked about where it's sideways, you don't have to wonder what to do. You've already built that into your logic. So maybe at the end of the day, the truth is, at least for me, there's pros and cons to all these methods, and I want the best of all of it at every time, but I can't have it. So, you have to kind of perpetually sort of evaluate it, think about what's the right one for you, and then try to adopt that or do some combination of them in relation to what's the most suited to your temperament, right?
Yes, and that's the key, which is what's the most suited to you. And I think generally, like, I find that I like to have the systems keep me in line at all times. And I think that's important, but I also think that the extra part of it is up to you. Like, when do you need to take breaks? Like, do you have is there points where you are, because I've seen it happen where so many people who are systematic traders, they start to get so used to the system that they start to get lazy. They stop really running it the same way. They stop looking at it every, week even. They just start to go, well, everything's running, it's great. And they just kind of look the other way from it. And, when you start to get to that point, that might be a point you need to stop, take a break, reassess what you're doing. And that's more what I'm saying. It's not that, and I don't even, I know back testing wise, I don't think it makes me any more money to do that. But I do think when your mental health is okay, you will be the best trader you can be. If your mental health is not okay, you're going to be a bad trader. It's part of the thing, like position sizing, volatility to stop, and then your mental health. Your mental health has to be right up there too, because you will, of course, you're going to make mistakes. You're going to go on tilt. I mean, I've seen how many people have we seen over the years who've been like, man, for example, I had a trader who was systematic, and he did a very unsystematic thing, as he was just killing it in the markets in 2020 and 2021. And so he said, you know what? I think this whole 1% to my stop is ridiculous. My position sizing, I need to get bigger. I should start. I was like, what are you thinking of risking, 2%? He said, no, 5% per trade. And he lost half of it. 2022 happened, and he lost half of his account. So, I mean, it's just I try to always check in with myself. I think that's important as a trader, is like check in with yourself, see where you are. Are you in a place where you could go on tilt? So I think it's very easy to build new things into your system, new position sizes, new times to add leverage, new pyramids. Like when you're feeling really good, and then when you're feeling really bad, it's easy to go the other way and be like, I'm going to trade much smaller. I'm going to do it this way. And then you never get out of your drawdown. So there's a bunch of different ways to look at it.
And on that note, there was Richard Barge, who's in Unknown Market Wizards. He talked a lot about, he kept a kind of a journal, or I don't know what he called it, but a book, and he basically kept tabs on how he felt and how that impacted his trading outcomes. And if you're a discretionary guy, that's probably a good idea. If you find yourself like really emotional and you're trying to put on monster positions, that's, after a losing streak, that might be a bad idea. But yeah, I don't know. And thinking back just about this conversation, it's like, oh boy, I'm all over the place. But I guess the reality of trading is that there are pros and cons. There are different methods. No single one is right. They have different costs and different consequences, and some work well at some times and some work well at other times. And the question is, what are your goals and what are you trying to narrow in on to achieve? And probably the reality of it is, if you can build a robust system and you're not trying to make 100% a year, that's something that you can stick with. The more you try to make larger returns via leverage or concentrated positions, the more emotional challenges that you're going to come to, because there's no free lunch left in the markets, really, that I'm aware of. So yeah.
No, I love this, because it's conversation. Obviously, like the comments or people are talking about it, like it's a thing that's on everybody's mind, which is how do you handle these periods? And it's really important to understand, like, as a trader, are you able to trade through these times? Are you able to stop? Like, that's another thing. Like, I think people have trouble more than anything. Like, starting is easy. Anybody can put on a trade, but stopping is the thing I see that a lot of people have trouble with. And whether like, and yes, I understand you. If you're a trend following trader and you're just a system guy and you completely can take your mind and yourself completely out of it and you can just check in every day, great. But there's other things about it where it's like, there will be times where your mental health will be off. There will be times where if you're in the professional trading world, if somebody has a divorce, that most of the time they're going to tell you to take a break for a while.
Was that go ahead. Sorry.
No, go ahead. I want to hear what you have to say.
That was like a Paul Tudor Jones comment, and somebody on X made a comment. Like, so his thing was, if somebody's getting a divorce, he pulls the money right away from his managers because their head isn't in the right place. And it was sort of funny because somebody commented, was like, oh, that's great. Hey, I know you're getting divorced and it sucks, but like, I'm going to pull all the money from your funds. So you got another problem. But yeah.
I mean, it's true, and it might have just been one of those things that they listened to Paul Tudor Jones talk about it at one point, and therefore in the future they just did it forever and ever. But I'll see that this will happen a lot with managers who see their traders going through something, and that happens a lot. And I think it's important, because if you are going through something like that, you want to, and this is what I see a lot with traders, whether they're discretionary or systematic, which is, if something is going really bad in your life, you think in your head that if I made, let's say you make $5 million, if I made $5 million, none of my fucking problems will matter. Like that's really kind of where it goes, is like, if you make this amount of money, none of my problems will matter. And you start to like trade on tilt. You take these big positions. You think like you're super right. And you want to get out of that bad period of your life. I see that happen more than you'd think, honestly. That probably happens to every single trader I've known at some point, at some time. Somebody, they have death in the family. They are going through a relationship problem. They want to escape something else, whatever it is. Money is obviously an answer, but if you're trading like that, like the market has a way of just wiping you out.
Yeah, yeah. One of the things I like to do is obviously aggregate wisdom from people who have come before and been successful and find the consistencies. And I guess that could be tough because there's a lot of stuff online these days. I mean, especially like if you go on X, I mean, there's guys making 100% an hour type of stuff, right? But
An hour.
well, it's extreme. They never lose, right?
Yeah, they never lose any trades. They get it right every time.
right. And I guess there's no right answer to the trading game. Let me say, I don't guess. I know that. And ultimately, what I find to be helpful is to say, okay, if there is no right answer, the best I could probably do is get away from the wrong answers, like a multiple choice test, right? Like that's wrong and that's wrong and that's wrong. And the things that you do find are consistent are, aside from like cut your losses, ride your winners, respect the price trend, it's don't risk too much, don't get over leveraged in any one direction, and play for the longer term trends is one of the ones that I have heard over and over and over. And I don't know if you've read anybody who says, boy, you should be playing for the 12-second trend. I don't think it exists, right? And there are a lot of people that say the opposite. So maybe the right, quote unquote, right thing to do is to sort of know that there is no right answer and then aggregate the wisdom of the people. And if you find something that's consistent, try to get as close to that as you can, because there's likely a reason why they came to that conclusion, right? And it's probably the same reason that the guys, Druckenmiller, I think, said in a podcast he doesn't hire anybody over 30. And Jim Rogers said the thing about young people is they make a lot of money because they don't know why they're making so much money. And comparatively, people say old traders, bold traders, no old bold traders. These little bits of wisdom and pearls of wisdom can maybe combine to point you in the right direction, whether you're discretionary or systematic or some sort of hybrid, what I call processes. But anyway, you got to go in a minute, right?
Yeah, no, that's perfect. Great way to end it. All right, guys, thanks so much for joining us. This is a fun conversation to talk about discretionary and systematic. Hope you guys got something out of it. Let us know on Twitter. Definitely try to follow us on YouTube. We need more people on YouTube. Twitter, we get tons of people on Twitter all the time, but YouTube's been kind of a ghost town for us. So please go to YouTube. My link's right there at AAO Research. There's actually a ton of videos with George. George is huge in Turkey and with Turkish women. So if you guys want to see some of those videos, definitely check that out. All right, guys. I'll see you soon.